afternoon, everybody. Just waiting for everybody to jump online. I'll give it a minute or so before we start this presentation, and then we'll kick things off. Okay, so the time's now 12:31, so I think we'll get things underway just in the interest of time. I think we've got some people online now, so we'll get things moving right along. Welcome everybody this afternoon. My name is Ralph Lomu, and I'm a Member Education Manager here at HESTA. I want to thank you everybody for joining me for this financial wellbeing webinar on how to maximise your super. We're just going to sort of talk a little bit about financial wellbeing to start off with, and then we'll sort of talk a little bit about some of the things you can do to maximise your super. Hopefully it won't go too long. I will open it up for questions, so please feel free to use the Q&A chat box on your screen there if you want to type in a question, and I'll check that throughout the presentation to answer any queries along the way. I'll also have an opportunity at the end of the presentation if anybody wants to ask any questions, and we can sort of chat through some things there, but we'll get things underway. First things first, I need to warn you that any information I do share today is general of nature, so please don't consider this as personal advice. If you do feel that you are looking for some sort of personal advice and some sort of direction around your own personal circumstances, feel free to reach out to us in relation to that. I'll provide my details later in the presentation for anybody who wants to come reach out to me directly. You'll also receive an email or a survey directly after the presentation, which will also give you the opportunity to request an appointment with one of our advisors. So what is wellness? And wellness consists of a couple of different components. As you can see there, it can include things such as mental health, physical health, obviously workplace productivity, what you sort of do with the community and how you involve yourself with those people around you, or certain hobbies and interests that you take up. Your family obviously plays a big part in that, but also financial well-being is the part that we come into play in relation to how that sort of plays in your overall wellness. And as you can see, there's so many decisions to make around different parts of your life. And that's where we sort of want to help a little bit around the financial well-being piece into sort of clearing out a couple of the questions you might have around, your future and retirement, but also sort of, I suppose when you sort of talk about financial well-being, superannuation does play a component in the, I suppose, in the long term when it does come to retirement. Financial well-being. Now, I suppose there's a couple of parts to financial well-being and how it's sort of perceived by different people. And I guess there's the different parts of it, is how aware are you of where your money is and how much you have at the moment. Also, how others perceive your financial status and where you sit with your finances. And, you from time to time, you'll see certain people, and they'll sort of make an assumption around people's wealth and how they're sort of doing in their lives, just basically around, whether there's been some sort of purchases or, what they're doing in the way of holidays and things like that. So, there's also that assumption from other people as to, how they perceive other people and their financial well-being, just basically on their current wealth and what they're sort of holding in the way and what they're sort of doing in their sort of day-to-day lifestyles. But also, you tend to find over the barbecue conversation, people do sort of tend to offer a lot of information. But I guess, one of the key parts is, how well are you sort of prepared for your financial future, and how secure are you, not only around the retirement piece, but just sort of in general, whether you have young families and how you're sort of setting up the kids for the future. And everybody has a different sort of level as to how they want to sort of make sure they're quite secure in those sort of circumstances. And sort of just to touch on, some of the things I've sort of spoken about already, this is typically what a financial journey may look like over, an individual's lifespan. And as you can see, there's so many financial decisions along the way that need to be made, ranging from, starting your first job, opening your first bank account, then sort of starting at uni, and then even sort of taking up your first full-time job after you sort of graduate. Moving out of home, buying your first home, and then sort of starting to rear a family and sort of understanding where you're going to send the kids to school, whether you're sort of operating on two incomes or one income. So as you can see here, there's so many decisions that sort of are at play during that sort of life stages, or different life stages in your whole financial journey. And I guess this is where, financial well-being for us is such an important thing for a lot of people, because here, I could sit here talking about superannuation till the cows come home, but there's always different components, different parts of each household that they sort of need to sort of juggle to make sure that it all works. And this is sort of one component when we sort of talk about superannuation and how that's going to fund your lifestyle. But I guess what we sort of try to encourage our members to sort of think about as to how you sort of start doing a little bit now without having to sort of feel like you have to do a lot more work later on. And I guess this is, just to sort of demonstrate how complicated it can get when you're sort of looking at your own personal situation and some of the decisions you need to make around your finances. And I guess there's always studies, and Bupa ran a bit of a workplace health report some time ago, just to sort of really assess how important financial well-being, not only for individuals but also for employers, because this is something I suppose employers have found that is quite important, in the sense that whether it affects their productivity, the lack of education around and information around, how well are they doing in the way of their finances, the stress and how that sort of carries over into the workplace and what that could cost an employer. And even sort of just talking about, family issues within the particular household, as to, when you have two different decision makers, from time to time, you can see they have different perceptions as to how they feel financially secure, or how they sort of plan to sort of move forward and build themselves a bit of a financial security around that. So I guess this is just to sort of demonstrate how it sort of can spill over, not just from within the household, but it can spill over into sort of, the mental health space in relation to your family and your sort of individual stresses at home, also to how that can sort of spill over into the workplace, and, why that might be sort of something paramount for employers to look at and maybe sort of assist in any way they can. Yeah, and so time to time we sort of take a cross-section of our membership and sort of ask them a little bit about, their financial future. And it's just quite surprising. I suppose the two things that surprised me out of this particular slide is that 73%, of our membership don't know how much money they'll have for retirement. And so that's where the advice piece becomes very important, because not only can they sort of help you with that, but also they can sort of tell you whether they, some of the things you can help to improve your situation if you feel that it could do with some tweaking. And also, just maybe get a bit of a pulse check on where you sort of sit with things. The other thing that sort of highlights from this slide is, 60% of our members worry about running out of money in retirement. And I guess that's where we sort of go down through the advice process. It sort of encourages our members to sort of think about, what kind of things are you sort of looking to do, and not sort of getting a hard and fast sort of plan around what you're going to do in retirement, but sort of building a little bit of an idea as to how that may look. Understand what it may cost you to sort of live that particular lifestyle, whether your home will be paid off at that point, or whether, some of that's going to be paid off from some of your superannuation savings. So once you sort of build a bit of a picture around what that might look like, then you can sort of start planning towards that. And, that might change along the way, based on different circumstances. But I guess it's just to sort of start with some sort of a blueprint to understand where you're headed to. Now, from time to time as well, we sort of survey our membership just to sort of understand, how prepared are our members for retirement. And I guess you'll see here there's sort of a different group of so we categorise our membership into two different groups, and some of the terminology might be a little bit awkward here, but I guess we sort of categorise it into sort of 5 different categories, in the sense that we look at some members that sort of might be just starting out and they're in the early stages, so they'll probably fit into the category of first steps. But then we sort of go to the other spectrum where some members who maybe sort of feel a little bit overwhelmed by all the information that superannuation can provide as well. So it can be a bit of a beast to sort of get your head around as well. So I guess for some people it might be too much, so therefore they sort of maybe avoid trying to understand it, and maybe getting a better understanding of what they currently hold in the way of their super, and maybe sort of building a plan. And then you've got those that are sort of maybe that they've got a handle on things and they sort of know what they're doing, and then sort of maybe just flying into that that stage of understanding what they really do have in the way of superannuation, and have a little bit more clarity around what their plan is into their financial future. Now, I thought just understanding all that about financial well-being and sort of, now that we sort of covered off, the reasons why we sort of think it's something important, and why we sort of work with, organisations like Life Without Barriers, just to sort of really understand, some of the things that employers are wanting to sort of help their staff members out with, but also for us to make sure they actually remain relevant and relative into relation to, why would superannuation be an important component of your financial position? And I guess one of the key things that I like to share with members, and a good starting point, is really understanding, some of the numbers around this. And this particular slide and the numbers that come from this slide were generated by ASFA, who's the governing body for superannuation. And what they've sort of come up with is a bit of an idea of, after surveying retirees every year, what they've done is then sort of start to build around the numbers of what income needs might look like for a modest lifestyle in retirement versus a comfortable lifestyle in retirement for a single or a couple. Now, when we sort of talk about a modest lifestyle, we're sort of really talking about the absolute basics, and just being able to fund, the day-to-day, getting the bills and utilities paid for, obviously the running costs of that particular household. So just being able to cover that. And as you can see, then you go to a comfortable lifestyle, which actually affords you a little bit more of the luxuries around what you can sort of do in relation to maybe dining out once a week, or whether it's entertainment, or whether it's just travel once a year. So I guess that's where they sort of draw the mark between a modest and a comfortable lifestyle. But I'd like to draw your attention, I think, to the bottom line there around the capital that's required for those different types of lifestyles. And I think the reason why I do like this slide is because I think it sort of moves away from the misconception that some years ago that was sort of pushed a little bit around people needing $1 million in retirement to have a comfortable retirement. And as you can see with the capital that they've sort of quoted here in relation to a single or a couple, you can see it's a lot less than $1 million. And I guess the reason why as well is this is based on the fact that the age pension may play a part in funding some of that income for couples or a single. And as you can see, for a couple here, for $640,000 combined in the way of super, they can live a fairly comfortable lifestyle. Obviously, a big portion of that income is drawn from their superannuation, as you can see at the top there, and then the age pension will make a portion of that income needs as well. So, combining those together, 37,000 of that, 62,000 is coming from an age pension, and the income gap of 25,000 is obviously coming from your superannuation, to give you that total of $62,000 a year to live a comfortable retirement. And that's assuming that you own your own home. So I guess it's a little different if you're sort of looking at renting. But yeah, look, I think this is a sort of a good basis to sort of start with when you're sort of looking at what is it that you need to live a comfortable retirement, whether you're a single or a couple. Now, in saying that, it's important to understand, when you can access your super. One of the common misconceptions I also tend to find is people think that they need to retire at a particular age, which is not the case. You can retire at any time you want. The only thing I would say to you is understand when you can access your super and when you can access the age pension. So they're both age-based, and as you can see here, depending on when you were born, will depend on when you meet your preservation age, which is the first requirement you need to meet before you can decide whether you want to access your super. Now, the only thing I would say here is if you are in the bracket that's lower than 60, then you have to take in consideration there may be tax payable if you access any funds from super prior to 60. After you turn 60, then all the super is tax-free. So that's one particular part that you need to sort of think about when you're wondering when you want to retire and how you're going to fund your retirement. So preservation age for your super is one part. The other thing to think about is when you can become eligible to access the age pension. And as you can see here, it's the same sort of system. It does depend when you were born, but if you were born after the 31st of December 1956, you'll see that the earliest you become eligible to access, become eligible to apply for the age pension will be 67. Now, there's a real big gap there if between when you can access your super to when you can become eligible for the age pension. So that has to play a part in your considerations when you're thinking about when you decide to retire. If you decide to retire around 60 and want to sort of access the age pension at some point, there may be some time there where you need to access, where you need to fund your lifestyle completely from your superannuation funds before you reach your eligibility age for the age pension. Now, in understanding that, obviously, one of the things we do encourage our members to think about is if you feel that you're maybe a little short in the sense of where you might sort of get to in the way of your retirement objectives or your retirement goals, and that that sum of money that you think you may need to get to a comfortable retirement, based on what we sort of saw earlier from ASFA and the statistics around that. Some of the things you can do to sort of help yourself a little bit is think about making extra contributions into your superannuation. And there's two ways you can do this. You can do it before tax or after tax, and there are limitations around that. So if you are making before tax contributions, there may be a bit of a tax benefit for you, which you can discuss with your accountant. If you haven't already done your tax this year, probably a good time to sort of have a chat to the accountant about that. But there can be a tax benefit for you in the way of how it's taxed. And I'll show you just a quick example shortly after this. But the limitation of $25,000 before tax does include what your employer pays into your superannuation balance as well. So just be mindful if you are making those extra contributions and you're making a substantial amount pre-tax or before tax, that you have to be careful that you don't exceed that $25,000 limit. Now, on the other hand, if you are making after-tax contributions, you have a limit of $100,000. So that's money that's already been taxed. And yes, it is quite a large limit. People ask why. And that sort of caters for situations where people may receive a redundancy payment, may receive proceeds from the sale of a property, or they may have received an inheritance. So there's a couple of reasons why people may sort of utilise that higher limit for an after-tax benefit, and that's all funds that are already being taxed or tax was already being paid on that. One other rule that they have around that as after-tax contributions is you can actually bring that $100,000 limit 3 years forward. So you can take 3 years worth of contributions of $300,000 and you can bring that into 1 year. However, you can't make any further contributions for the following 2 years. So as I mentioned, around the tax benefit you may receive in relation to making contributions before tax into your super. Now, As you can see here, there's a flat 15% on any contributions you make into super before tax. So when your employer makes the contributions, it's only taxed at 15%. Any contributions you make pre-tax as well are also taxed only at 15%. Now, if you're in the tax bracket, in the middle tax bracket at between $37,000 and $90,000 a year, your marginal tax rate is 32.5%. So what we're saying here is, if you're making the contributions before tax, you're only getting taxed at 15%. So for $100, you'll get $85. However, if you're to receive that $100 as normal pay, you'll be taxed at 32.5%. So you'll receive less money. However, but the benefit here is you'll get more in super. However, you can't touch that till you reach your preservation age. Now, if you're looking to do any of these or making extra contributions pre-tax, you can actually speak to your payroll office or your payroll team, and they'll speak to you about what the process will be to make those extra contributions and have that deducted from your pay. The other thing is, if you're receiving salary packaging or you're utilising the salary packaging, you can speak to your salary packaging provider as well, and they can talk to you about making those contributions. Now, if you are a member of HESTA, you can log into your member online through our website, and it actually provides you with the BPay details for you to make extra contributions directly into your superannuation account. So I guess the benefit of doing that sometimes as well is, if you're making BPay payments, you can start that at any point, but then next year you can actually stop that at any point if you feel that you need to sort of readjust the budget. For those of you that are sort of in the low income bracket, so if you're earning less than $37,000, there are a couple of things you can think about. So for those that are earning $37,000, the government will refund up to $500 of contributions tax if you're eligible. So what happens is, if you lodge a tax return and it's lower than that $37,000, what they'll do is look at the tax that's being paid on any of your contributions into your super, and they will refund automatically up to $500 and just place that back into your superannuation account. Now, if your spouse is wanting to contribute on your behalf and you fall below this particular number per annum, they'll also get a tax rebate if they contribute up to $3,000 into your superannuation account on your behalf. So what they'll do is they'll receive up to about $540 as the rebate on their tax return if they are making contributions on your behalf. And I guess the benefit around that as well is, every little bit counts, obviously, but the extra money will go into your super straight away, and it starts working for you immediately for that long-term view. One of the most recent schemes that have been sort of introduced by the government is the First Home Super Saver Scheme. So as at the 1st of July 2018, what the government has said is, if you make any extra contributions into your superannuation fund, you have the ability to draw up to $30,000 of that money that you've put into super as a deposit for your first home for your first home. So it's probably beneficial for a lot of those young ones in that cohort who are sort of looking at buying their first home and wanting to save a deposit. I guess the key thing here is that they're not able to touch it, so it's not a bad way to sort of get money and save it into super. I guess the other benefit as well is you're not earning a lot in the banks at the moment. If you're sticking your funds into a bank account, the return is not that great. So you sort of benefit on two fronts, in the sense that you do get the sort of better returns in around your money that's in super, but also you get the ability to draw that back up to $30,000 towards that deposit when you decide to purchase that home. Oh, and the other benefit as well is, if you're making those contributions into superannuation as well, if you do it pre-tax, obviously you're getting a lot more into your superannuation account as opposed to having it taxed at your marginal tax rate and then sort of sticking that in the bank and not earning a lot as well. So it's sort of taking benefit from a couple of things there to sort of get to your end goal. One of the other things as well to think about, which is quite important in the way of your superannuation, is sort of understanding the investment strategy that you have in place for your particular portfolio. As you can see, it does consist of a couple of components, normally sort of split between growth and defensive assets. So or asset classes. And so when we sort of talk about defensive asset classes, they are sort of a little bit more steady. They don't sort of tend to fluctuate too much on you, but you sort of see less movement over the short term, but over the long term, they have delivered probably a lot less in the way of returns, but they are quite steady over the long term. So you won't sort of see it behave in a pretty erratic way. Whereas on the other side, when you look at sort of growth investments, such as property and shares, they tend to be a little bit more volatile in the short term, but over the long term, you can see they probably have the potential for a lot higher returns. So what I mean by that, I guess, is what you'll see here on the screen. As you can see here, the difference between the cash, as you can see in the bottom level there, sort of steady over the long term versus our conservative pool and the core pool. Look, the numbers that they've come up here is based on the fact that if you had $50,000 at the bottom of the GFC back in 2009, you would have ended up with 1.5 times your money if you stayed in the core pool investment strategy, which is now renamed to our balanced growth investment strategy. Similarly, with the conservative pool, if you had $50,000 at that time, you would now be looking at double your money from 2009. So when I was sort of talking about how these different investment options or portfolios perform, now because as you can see with more growth investments in the conservative and the core pool, as I was saying earlier, the fluctuations or the volatility you see along the way, yes, it does look a little bumpy on the road, but potentially over the longer term, you're looking at a higher return for those different investment options. And here are some of the numbers just to sort of give you a fair idea. As I mentioned, the balanced growth, which is the default fund. Look, it returned, it was a flat return for the balanced growth last year. Given a really tough year this year, I guess it's probably good in the sense of what we sort of were able to sort of recover in the, after sort of the February-March period. But I think the thing I like to highlight here in this particular chart is even though with a flat return this financial or last financial year, the 10-year figures on average for the last 10 years, you would have still averaged 8.01% in the way of return. So the flat return last year was counteracted by some really good years previously. And I guess that's the whole aim of when we're sort of looking at super in the sort of long-term play, as we sort of saw in the previous chart that, you may see sort of some years where they weren't so great, but obviously the key thing is over the longer term, you want to sort of get a steady increase. And obviously, the higher the risk, the higher for potential returns, but that's where you sort of really need to sort of understand where you sort of sit in the way of how you sort of deal with risk and how what sort of level that is appropriate for you and that you can manage. And I guess, you sort of go through this journey. And the reason why I like this particular chart is because it sort of came to light this year in the sense that when the market sort of moved quite a bit and then sort of showed a little bit of volatility this year, these are sort of some of the emotions that people may sort of dealt with along the way when they were looking at their balances sort of, December, January, it would have looked really good, and they're sort of, they talk about excitement, and there's a lot of thrill and euphoria around how well it was doing, and off the back of it, some really great years. But I guess when sort of things started to turn and the global pandemic was announced, you'll see some of the anxiety and the fear around, where the superannuation balance is sort of going, and a little bit of panic set in. So, we noticed a lot of members were sort of ringing us and asking about, where is this going to go? I mean, there was a lot of uncertainty around where we thought this would sort of play out in the markets. But I guess the key thing to note was a lot of it recovered after February, March. And sort of April, May and June were really good months in the market. So the lesson there for a lot of people was those that sort of moved out of the markets, may have sort of tried and probably are still trying to figure out when is the right time to go back in. And I guess that's where we sort of want to sort of let our members know that our investment management team, we have absolute faith in them and we think they do a fantastic job. And I guess that's where the expertise lies, in them sort of managing through these particular situations, and their view is always going to be long term. So I guess the thing is to rely on their expertise to be able to manage through these times, rather than allowing our members to sort of maybe pick the right time to sort of move out and move back in the markets, because it's really a tough one to sort of pick. But when you sort of ask, when is the right time, it's a little difficult to answer, given that, if it isn't the right time and sort of move your money back into the markets and things sort of have to develop over the next, month, and it doesn't work in your favour, then obviously people may sort of regret their decisions. So it's really just, I suppose it's really just having some sort of conviction around your investment strategy, and sort of maybe sticking with it to understand that it is a long-term play. One of the other key things to think about as well is looking at insurances. So, all good and well to sort of maybe think about contributing into super and having a bit of a plan, and sort of understanding what investment strategy is going to sort of help you in the long term. But I guess, where insurance plays a part is that's assuming everything goes well, and you're still employed and you're able to sort of fund, putting extra into your super. But, things do happen throughout. So, I'm sure that people have sort of had friends, colleagues or family that may have sort of gone through some sort of situation where there's a loss in the family, or there's a loss in somebody's sort of particular bubble or household, which dramatically affects their financial situation. So I guess that's the way we sort of tend to position insurance for our members, just to make sure that they have sort of thought through all the risk factors and looked at how they can sort of mitigate that. If anything was to happen to sort of the main financial income earner in the household, how would you sort of deal with that? How is that sort of how the bill's going to be paid? Things like, how the children's tuition fee is going to be paid. What about the mortgage repayments? So there's a couple of factors we sort of encourage our members to think about, and sort of when you sort of talk about insurance, just to make sure that you have all those risks mitigated somewhat. It may not necessarily have to be from insurances all the time. It could be also, if you've built yourself a buffer in your mortgage, that might be the sort of backup there in relation to, covering yourself in the need if a situation arises. And I guess when sort of the different insurances we offer is, obviously there's death in the situation of, you passing, you receive a lump sum in the way of an insurance payout. Then you also have IP, which is income protection, which pays you in the situation if you're off work due to injury or illness. You'll receive a monthly benefit. And when you join HESTA, you automatically get up to $950 benefit automatically once you join. So if you feel that you need more coverage in the sense of that, jump on your member online. You can do yourself a quote to understand how much it's going to cost you before you go ahead with the application process. Now, death and income protection automatically is 2 units of each is afforded to you as soon as you open your account. However, we do offer total permanent disablement, but it doesn't automatically come to you as soon as you join HESTA. Now, total and permanent disablement is to pay you a lump sum in the instance where you become permanently incapacitated or disabled due to injury or illness. One of the things that we do also offer around insurances, so for those that are going on parental leave, whether it's maternity leave or paternity leave, so as long as the employer lets us know for how long you're going to be off work for, or due to that sort of leave, then at least we'll put your premiums on hold for that time and just keep your insurance policy within your HESTA account still going. So we won't deduct any premiums, but we'll still keep the cover there for you. So this is something that just to sort of maybe let your peers know if anyone's sort of going on leave and they are sort of thinking about taking extended time of leave, just to let the employer know for payroll to advise us, and we'll put those premiums on hold. Speaking of insurances and in situations where we may sort of leave loved ones behind, it's important for people to sort of think about nominating their beneficiaries on their account. So there's a couple of ways you can do that. The reversionary beneficiary probably doesn't apply because that's in relation to our retirement product, but preferred and binding. So the difference between that is if you open your account, you can nominate a preferred beneficiary. I guess that sort of sort of does give you the ability to nominate a beneficiary, but what it means is if there's any questions or if there's any challenges in relation to that nomination, we as HESTA, the trustee, have the discretion to sort of decide where those monies are paid to. Now, if you want to take the discretion away from HESTA and any questions around that, then you can nominate a binding nomination, which is just a matter of downloading our binding nomination form online, filling that out, getting it witnessed, and then sending it through to us. And that's only valid for 3 years. And then every 3 years, as we approach expiry for that binding nomination, we'll send you out a new binding nomination form, just to whether you want to make the same nomination again or whether you want to change that nomination. So there are some sort of recent announcements as well that were sort of announced by, in the most recent budget, which are a couple of tax benefits for just average income earners as well, for Australians as well, sorry, in relation to changes to the tax bracket. So you might see a little bit of a benefit in the way of taxes, which is going to come through. I guess some of the future changes they're proposing, the abolishment of a particular tax bracket in there. So there's a couple of changes coming through in the way of tax, but we thought we'd sort of bring that up in relation to that, seeing as it's very topical and the sort of news came out not so long ago. So for those that are sort of thinking about, whether I need any help, or sort of thinking about, is it a good idea for them to sort of seek out any support in relation to their superannuation or what their retirement goals and objectives are, I guess this is just to sort of highlight some of the reasons why you would call on support. Obviously, we mentioned earlier some of these numbers we already shared in relation to those who are looking at running out of money in retirement. Those are not sure that how much money they'll have in retirement, but those that are sort of receiving advice are on average better off by about $100,000 or more in the long term. So a couple of key reasons why we sort of encourage people to sort of seek out support from our advisors. Just letting you know that if you have a HESTA account and you're looking at getting advice from our superannuation advisors, that is at no cost to you. So it's all incorporated in the administration fee that we charge, and we believe that it's important for our members to get this type of advice. It's not rocket science, whether it's just sort of getting your investment strategy a little bit, a little bit straighter, looking at the insurance to see if it does what it needs for you and covering all the things that you feel might be important to you and your family, even contributing and seeing what that might look like, understanding what your budget might be, obviously, but making sure it's affordable and so that you can sort of maintain that over a longer period of time. And I guess they're just some of the things that we can definitely help with, but obviously we don't want to sort of charge a fee for that because we believe that's only going to help you in the long term. Now, if you sort of feel that you can be a little bit more self-directed, there are some tools and calculators that are available online through our website, and plenty of information on there as to how you can sort of work out what the difference will be if you're contributing a little bit extra, what that'll do for the overall balance in the long term. So there's a couple of pretty cool resources there on our website, which we encourage you to sort of have a look at, maybe just to understand some of the questions that you might have and how you can sort of answer those. So I've just popped up my details in relation to my email and my mobile number. So if there's any information that I've shared today and you feel that, look, Ralph, I sort of need to ask you a couple of questions about some of the information you were sort of talking about, feel free to reach out to me via email or directly on the mobile. I'm more than happy to sort of share, and talk through some of the sort of finer details around that. Look, if you need me to sort of put you in touch with one of our advisors, more than happy to sort of book in the time for you as well. But we can just sort of have a preliminary chat around your current position, some of the things you're thinking about doing, but we're happy to sort of help in any way. So feel free to take my details down. For those of you that are sort of possibly looking to join HESTA, there is a URL link. That's the URL link. You probably can't click it on your screen, but if you jump in onto our website, on the top right corner of our website, you'll see there's a click button there to say join. Look, it's a pretty easy process. It'll probably take you no longer than sort of 10, 15 minutes to join. Just remember to have your tax file number handy. If you don't have it with you, that's the only information that they'll require that you might need in front of you when you're sort of setting that account up. But I think that brings me to the conclusion of our presentation. I'll just have a quick look in the Q&A section to see if there's any questions that sort of been brought up. Nope, it doesn't look like. But look, just while you're thinking there, as I mentioned earlier, look, the advice piece is quite important. We do sort of encourage members to sort of have a look at that. There are a couple of links. So ASFA, which is ASFA, in relation to sort of those numbers that I shared around a modest and a comfortable retirement. There is some useful tools on their website which talks about, you know, the cost of living and how much that will look like. As I mentioned, they've broken it down into sort of an annual figure, but they've got some documents on there in relation to sort of breaking it down for you in relation to how it should look on a sort of monthly basis, you know, even down to the detail of what groceries might look like, what utilities, insurances, entertainment, you know, so if you sort of want to get a better understanding of how they sort of come up with those numbers about a modest and comfortable retirement, that's the place to go. The ATO is also a really good source of information as well. If you're looking at consolidating your super, there's some great tools on not only on your member online through HESTA, but also through the ATO. There's some great tools there. Like I said, our website is a wealth of information as well. And I think you should sort of have enough there in the way of, you know, some light reading to do. But look, I just wanted to sort of thank everybody for their time this afternoon. You know, appreciate you taking the time. I appreciate the opportunity from Life Without Barriers to sort of work with you in relation to this. But look, I think there doesn't seem to be any questions at this time, but I'll give it another 30 seconds and I'll sort of hang online for those that are sort of keen to sort of ask any questions. But for those of you that need to sort of jump off now, thank you so much for your time. I appreciate you taking the time out of your day to listen to me. And thank you once again. And please, everybody, take care and look after yourselves. Thank you. Okay, it doesn't look like there's any further questions. Once again, thank you all. Appreciate your time and enjoy the rest of your week. Thank you.